Hey everyone, Meet Kevin here. Wow, we had a wild day from like an insane low this morning. Tesla at 790 to Tesla being up 2% on the day and everything going great. This is such a volatile market. It is insane. And it creates some opportunities. But we're going to talk about why was the market green today and what did the Federal Reserve just say that actually added some color and a little bit of guidance and a little sort of suggestion regarding what could happen with inflation, rate hikes, and the future. Let's talk about that. Quick note, this video is brought to you by The Daily Upside. There's a link down below for The Daily Upside if you want your news in 5 minutes or less sent to you via an email. Check out The Daily Upside, link down below. Great morning newsletter. Check it out. Totally free, by the way. Okay, let's get into this. So, Neel Kashkari. This was interesting, okay? I was surprised when I saw some of these headlines, and these headlines weren't in the terminal. They were on smaller news agencies. Well, I guess I shouldn't necessarily say smaller. It was like Yahoo and other Market Watch and stuff like that. I guess they're probably smaller than Bloomberg, but whatever. And the headlines were things like, Neel Kashkari says maybe only 2 rate increases this year. Neel Kashkari says Fed might pause in spring. And I'm like, oh my gosh, those headlines are actually really bullish, because if you think about it, we've been told from the Federal Reserve they're planning to do 3 rate hikes. Last time the Federal Reserve said they were going to go from 3 rate hikes to 2 rate hikes, it was the end of 2018, and the market started rallying again after that. It's like, oh, is that potentially the reason? Do people have memories of 2018? And is that actually what he said, right? Some things to talk about that. And this pause in the spring, I mean, what? So like raise rates and then just like chill back and do nothing? So I saw those headlines and I'm like, oh, it sounds a little weird on the Tesla. Anyway, what is that? I don't know. Tesla. That's why it's down 31% this year. Anyway, so I'm like, okay, let me read the transcript. So once the market was closed, I'm like, let me figure out exactly what's going on. I went through the transcript, and here's what we know. So first of all, Neel Kashkari, and this is really important to know, when you line up the Federal Reserve board members, Neel Kashkari, on a rank of who's most dovish to who's most hawkish, in case you don't know what that means, a dove, like a little birdie, is like, oh no, don't raise rates, it'll be okay, things will get better all their own. That's a dove, right? Well, just give me some crackers to chew on and leave me alone. That's a dove. And then a hawk is like, no, I'm not going in there, I'm going to kill inflation, I'm going to take this down. Okay, that's a hawk. On a scale of who's most dovish to hawkish, so hawkish being at the bottom, dovish being at the top, Neel Kashkari literally ranks at the top. He is the most dovish there is. He don't want to do anything because he doesn't want to see us go into the R-word recession. Okay, so he gave us a little bit of insight in terms of his thoughts, and then now we're going to get some insight as well into like where did this clickbait come through from those headlines. So first, on supply chains, he talks about, because of the supply chain issues, having penciled in 2 rate hikes for December. But this is a little bit misleading because most Fed board members are raising their estimates for rate hikes after December. Powell said that on Wednesday. So I hate to say it, but whoever ran that article, whether it was Reuters, Yahoo, Market Watch, I have to call this one clickbait. Neel Kashkari did say in the interview, I penciled in 2 rates for 2022, but again, he said in the interview, he's probably moving this up because things have actually gotten worse since December. Now, the only company so far to indicate that things have gotten or might be better in Q1 of 2022 is Apple. But they still say, even though things are going to be slightly better, we're still going to have, quote, significant supply chain constraints. There was a little confusion this morning because I mentioned that in a video, but some people are like, oh, but Apple said it was better. I think this again was a little bit kind of clickbait headline today, where the Apple news was that, oh, that's it, supply chains are getting better. No, not quite so fast. Apple literally in their earnings call, you can see it on my Twitter, said we're still experiencing significant supply chain disruptions. That was their word. I'm not adding the word significant. They said that. There's, I think, their chief financial officer or whatever in their earnings call, they said that. And their primary chip supplier, one of their primary chip suppliers, says they don't actually expect supply chain shortages to get better until 2023. And that's one of the primary suppliers for Apple. So a little bit of clickbait on the Apple news. little bit of clickbait so far on this 2 rate hike news. Now, there is good news in what Neil says. I don't want to like take the good news away. I want to provide good context because I want the market to do well. Recessions are bad. Everybody loses money. It's not good. And it's also very hard to open new businesses in a recession. You want to open new businesses when things are booming. It's a lot easier to do that. And I have plans of doing that this year multiple times. But anyway, one of the other things he told us is that one of the big things we've got to watch is how fast workers come back. He said what was unique was looking back to 2017 and 2018, we would see labor participation go up in the later part of the economic expansion. So what that means is as you're getting towards like, all right, this expansion's been going on for 10 years since like 2008, more marginalized workers potentially come into the workforce because businesses are broadening their reach for who to pick. So people potentially with lower skill sets, different races, different sexes, whatever. And that's a good thing. The Fed wants that. That's their version of maximum employment, is trying to make sure that as many people as possible can be in the labor force. But the problem is, he's saying we've got to watch in labor reports, and this is a big catalyst, okay? You want to write this down. If you have not written this down on your calendar, I think you're making a mistake. February 4th, March 4th. Feb 4, March 4. Those are Fridays, and those are at 5:30 in the morning when we are going to get labor reports. And he says one of the big catalysts for us basically slowing down or maybe pausing, we'll see, he says conceivably that we could pause if things come in substantially better, right? Big if, which again means the headline was kind of clickbait about the pause thing, because he also had some other ifs in the other direction, which we'll talk about in a moment. But anyway, what he's looking for is labor participation. So seeing that number, which I think it's at like 66.7, I think it went up like 0.1% from the last month. And what we want to see is we want to see that number tick up. So that's a big catalyst, the Feb 4 number and March 4 number. The problem is because of Omicron, it's entirely possible that that participation number could actually go down a little bit before it goes up. So there could actually be more bad news before good news, which isn't great, because what we don't want is bad news at the beginning of February, and then everybody's looking forward to March 16th going, oh crap, the Fed's about to raise rates 0.5%, and then we get a February freak out. Freak February. That would be bad. We want rally Feb, right? And we want positive catalysts. Like, we want real catalysts. We don't just want, momentum traders pushing stocks up to the moon and then they collapse right back down, because then that's not real stock growth. We want real stock growth. And we get that when we get positive catalysts in the market. So mark your calendar. March 4th and Feb 4th, both of those, we want to see labor participation come up. He says it is critical to see that labor participation come up. Then the next thing is obviously inflation. Okay, mark your calendar for this one. Feb 10, March 10. So 4-10, 4-10. Feb 10, March 10. The Feb 10, March 10, that's when CPI comes out. He does say, and he's the most dovish, he says, look, inflation's lasted longer because of the COVID shutdowns. He does think we could start to normalize this year, quote, if that labor force participation goes up. That was a big if for him. He mentioned this probably 3 or 4 times, that we got to see workers come back and supply chain issues to work themselves out. He's, as a dove, remember the dove doesn't really want to do anything. The dove wants supply chain issues and companies to resolve their own problems. By the way, I'm driving to go skiing, and in case you're wondering, it is my birthday, which does mean the coupon code for the programs on Building Your Wealth, link down below, does expire later today. So check that out if you have not checked it out yet. We've got the Path course with lectures coming out tonight, the first big batch. You get course member live stream for life. And when I buy back in the market, you'll be the first one to know what I buy. Do I have shorts? What am I doing? Right now, just in full transparency, the only puts I have are on Lucid. I'm just kind of hodling those until their earnings. But anyway, so, okay, then he says things should start to normalize. His focus, though, and I thought this was a really good piece of information, says his focus for when inflation is going to come down is actually the 12-month figure that maybe by mid-year we'll start to see inflation numbers roll down, so that way those higher prints start rolling off, was his quote. Now, I doubt that a little bit, because last summer the inflationary readings actually came in lower. We weren't doing too bad with inflation. We kind of had like a flat period in the summer, which is not so good about potentially numbers coming down in the summer. Inflation really came in high in like October, November, December. And maybe that's when we start seeing year over year smaller numbers, because obviously if you're measuring compared to a higher number last year, it should be easier to come in with a lower inflation print. He does think that inflation expectations are stable because, and this was a big one, because the Fed has set the proper inflation expectations. So he believes because of the Fed's communication, inflation expectations are stable. Now, what's really interesting about this is, first of all, you can measure inflation expectations by looking at the 5 or 10 year break-even charts. You can even look at like the 2-year break-even charts, and you're trying to find stability on the right side of that curve to where it's not skyrocketing. When it's going up, that means people think inflation's going to be worse in the future. The bond market's pricing that in, not necessarily people. People would be like consumer expectations, right? But anyway, he says there are 2 things that are important. First, if inflation does come down, then we can do less, which he wants to because he's a dove, right? But listen to this one. He says, quote, "But we need to start by walking the walk. We need to walk the walk. We need to walk the walk." He said that 3 times. So what does that mean? What does that mean when a Fed person is saying we need to walk the walk? Well, what he's saying is we got to go into March and actually do what we said we were going to do. We are communicating that we are going to end the taper in March and that we're going to raise rates. And he's saying it's time for us to walk the walk. Otherwise, investors are going to lose faith in us and they're not going to trust us anymore. And then they might think that we're going to let inflation go out of control. So he believes they're setting the stage that we are going to deal with inflation. That's why Jerome Powell was so hawkish in December. That's why Jerome Powell was so hawkish this Wednesday. We're going to deal with inflation. Possibly because Biden's yelling at him, but also probably because inflation's actually a problem right now. So they're communicating that, but the most dovish guy you got at the Fed is saying we got to walk the walk. Now, what's also kind of interesting to know about Neel Kashkari is he is not a voting member of the Fed. So when you're not a voting member for 2022, it means he actually has no say in the interest rate policy as to whether or not they hike in 2022. He does become a voting member in 2023, and since he's a dove, that would help maybe ease inflation, or interest rate hike pressures, right? Because again, he's a dove. Okay, good. Then, this was an interesting one, and this was the C word, okay? This was interesting. He says, the yield curve matters. This is how everybody's starting to talk again about the inverted yield curve and everything, right? Yeah, he says, the yield curve matters. In his opinion, not to predict recessions, but to try to let us know where the neutral interest rate is. The neutral interest rate is the interest rate where the Federal Reserve does no longer need to raise rates. Determining where that neutral rate is key. And he believes a flattening yield curve tells us maybe there's a limit to how much we could raise rates. That's bullish, by the way. However, what's not bullish, and remember, I'm always, no matter what side I personally am on, my goal is always to give you the facts the way it is. Whether it's beneficial or not to me, it doesn't matter. The facts are what the facts are. This was an interesting one. So that's bullish. That's bullish. Is basically saying there might be a ceiling on rates. What's not bullish, though, is this. He says, is it possible that we have to move to a net contractionary state, where basically they're tightening more because inflation's not coming down or workers are not coming back, which, hint, hint, so far, inflation's been getting worse, not better, says Powell, and we've been in more of an environment where workers are not coming back because they have more savings. People are retiring. People don't want to go and get AMI, especially certain older generations, so people are retiring older, right? Or earlier. Existing folks who are working are retiring earlier. And so he says, yes, it's possible. I don't want to do that mistakenly, but it is possible that we have to move to a net contractionary course. For now, though, we need to walk the walk. Now, folks, I'm not even done yet, but I don't know about you, but I want to ask you, let me know in the comments. Does so far, based on everything I told you, is it fair to have a headline that says, Fed sees 2 rate hikes, or Fed may pause in spring? Come on, man, that's bullcrap. That's bullcrap, because all of these extra details do not say those headlines at all. You know, total clickbait, which does partly make me wonder if some of today's rally was potentially a little bit misplaced. And so I just want to give a warning that what's going to happen next week is we're going to hear from some hawks. We're going to hear from some of the other Fed members as they go out on the press circuit and go talk the talk. And we'll see what they say. I imagine it'll be a little more hawkish than this guy. But anyway, he does say if supply chains sort themselves out, maybe we'll be good. The expectations are everything, though. And then listen to this. He says, quote, "We mean it. We're going to walk the walk." I think if the most dovish member is coming out saying we're going to walk the walk, I think all of the other board members, especially the Hawks, will be like, "We are raising rates in March." Now, Powell indicated that we want to raise rates steadily, so which kind of goes in contrast to this pause idea. And yeah, okay, good. That's all. So, what do we got? Well, we got a few things. Number one, you're going to go down to the link down below and sign up for the Daily Upside if you haven't done that yet. Why don't you want a quick little 5-minute newsletter to make sure you're caught up for the day before you begin your day? Number two, you got to make sure to check out the programs link down below on Building Your Wealth. And it's my birthday, so check those out. Birthday coupon code ends tonight. You can also bundle up if you want. And bottom line, folks, I actually think this is very, very crystal clear from Neel Kashkari here. He's very clear. He's the most dovish guy. The guy who's least likely to want to raise rates is saying we need to raise rates in March. We need to start walking the walk. We need to start doing what we're doing or say we're going to do, because we don't exactly know how much interest rates are going to affect the market and actually help reduce inflation. And if inflation gets out of control, then we've got issues. He does expect inflation prints will go lower this summer. I think it might take a little bit longer because the reads were a little flat in the summer. You could look at last year's summer and it was kind of like, oh, is inflation going down? That's cool. Things have changed. Boy, have things changed after Delta. But anyway, those are the notes from Neel Kashkari. I think they're quite useful, and we should take those into a Monday and see what news we get Monday, Tuesday, Wednesday, Thursday, Friday. Thanks, folks, for watching, and we'll see you on the next one. Bye.